Hello friends, it's Victoria with you and welcome to my YouTube channel. Here I trade binary options on the PocketOption platform, and I want to remind you that in the description below this video you'll find a link to my private Telegram channel where I share my daily trading signals. Useful and new information also published there. And if you text me personally, you will get a link to sign up for PocketOption with a gift deposit 50% absolutely free as a nice bonus. So guys, today I start with a deposit of $3,500. At the moment I see such situation, the price has approached the resistance level and is accumulating to break it. But I think it still needs to go down, but an inclined level for a breakdown. So I go on sale for $200. So how do emotions affect investment? By what right do impulsive actions displace logic when making investment decisions? Why do feelings rule more than reason? These questions answered today by the theory of behavioral finance. Behavioral finance. We are sorting out. So this is a business. Leave your emotions at the door, said DiCaprio's character, stockbroker and trader John Belfort in the film The Wolf of the Wall Street. Not a very good example of an investor who had big troubles in law, but despite this, there is no denying the accuracy of the statement. The theory of behavioral finance, also known as BF, describes the irritational nature of the behavior of investors and financiers in the market under conditions of uncertainty and risk. So neuroeconomics consider emotions to be a hindrance and difficulty of stock exchange activity, which must be learned to overcome. So meanwhile guys, the deal closed at plus $360. Nice. Okay, maybe it won't go down now, but in the future it will. For now, I'll turn around and go into the purchase for $200 again. The disgusting four. There are four main phenomena of cognitive distortion that science has spied on the financial market, starting with the tulip mania in 1636 and the California gold rush in 1840s. Behavioral economics summarized them, remember them, and punish them not to do so. Information cascade or a herd instinct. A situation where an investor relies on collective mind. In condition of economic turmoil, he acts with an eye to other market participants who have made the same choice and imitates them. Why is that? The investor didn't cope with the flow of information. Simply at first it didn't receive it in time, and when I didn't realize it. So meanwhile guys, the profit from the transaction is plus $360 once again. So actually the price has grown quite well. Perhaps I'll turn around and go on sale for $200. So the illusion of control, your self-confidence. The illusion of control is the tendency of people to believe that they can control or at least influence events that they have no control over in any way. Let's say there's a certain trader, Peter. He won back a high profit on the shares of some company. The next time he buys these shares again, however, he burns out and loses income. Why? What did he do? He expected a repeat of past successes in the future. He overestimated his competence. And you cannot do that. It should be borne in mind that each situation is unique and depends on new circumstances. So such cognitive distortions are characteristic, for example, of corporate employees in whose investment portfolio of securities of the company in which they work more than others. They are sure that they cannot work at a successful enterprise. as it was the telecommunication company WorldCom The bankruptcy of WorldCom was the largest in the history of the United States. Depositors lost tens of millions of dollars. All meanwhile, the deal brought me $360 again. Nice. So I will continue to jump from side to side. Now I'm going to buy for $200. So people tend to get attached to what they have invested in, whether it's money or emotions. The stock of a corporation that is liked and with which there have already been relationships before is always evaluated by the investor more optimistically than the stock of a competitor with perhaps better prospects. The cure is to separate attachments from money. Regularly rebalancing your investment portfolio according to the current economic situation is a successful example of suppressing the illusion of control. Player error or probability theory. So everything is very clear here. The most common psychological trap for a trader comes into play, which leads to incorrect investment and loss of capital. So the profit is once again plus $360. And as always, guys, I thank you for watching this video till the end. I hope you really like it, and I hope you don't forget to write your comments down below and make sure to subscribe to this channel, because there's always only useful information and the most interesting analysis. That's all for today, guys. I wish you successful trading sessions and see you in the next one.